Banking, Housing, and Urban Affairs Committee has come to order. Thank you all for being here. Senator Rounds will serve as ranking member again. His future may be cut short, I'm not sure, but that's for him and his friends to work out.
Looking forward to it.
Yeah. I will hear testimony from the heads of the 4 federal agencies responsible for protecting our banking and credit union system and making sure it serves everyone: the Board of Governors of the Federal Reserve, Federal Deposit Insurance Corporation, National Credit Union Administration, the Office of Comptroller of the Currency. Thanks for being here, all 4 of you today. Earlier this year, we witnessed 3 of the largest bank failures in U.S. history. These failures reminded us that bankers' hubris and greed and negligence continue to pose grave threats to our financial system and, perhaps more importantly, even to workers and small businesses. This time our system bent. Fortunately, it did not break. To avoid breaking, however, the Treasury Department and your agencies had to intervene, invoke the systemic risk exception, and guarantee all deposits at Silicon Valley Bank and Signature Bank. It should not have gotten that far. The bank failures exposed weaknesses in the supervision of the banking system, disrupted the financial system stability, reminded many Americans that why they don't trust Wall Street. A disconcerting finding in the aftermath of the failures was that the agencies did, in fact, identify the risks at these institutions. You called them out, but that failed to result in real action from bank management to actually do anything to mitigate these risks. It's as predictable as it is unacceptable after years of lobbying for weaker rules and weaker rules and lax oversight, including by SVB and Signature Bank executives showing up in the walls of Congress and in your agencies. We must turn the lessons of this year into action. It means improving bank supervisions. It means holding bank executives accountable for risky behaviors that does, in fact, sometimes drive their banks into the ground. It means strengthening rules so that banks serve their communities and have the capital necessary to continue to serve their community during even stressful events. These are things we should agree about. It's why in the wake of this bank crash, we worked together to take the first real action in more than a decade to rein in risky behavior by bank executives. Congress must finish the job and pass our bipartisan Recoup Act. Came out of this committee 21-2. Everybody on the dais now voted for it to hold senior bank executives accountable when they gamble with customers' money. The turmoil in the financial industry earlier this year reminded us about the policies and actions that continue to make the big banks even bigger and leave the financial system vulnerable to the ever-expanding bank balance sheets of the largest institutions in our country. We've created a financial system where a handful of the largest banks now hold $14.75 trillion in assets, $14.75 thousand billion in assets, more than half the nation's GDP. Fewer, larger banks means consumers have less choice in the marketplace for banking services. Less competition means banks pay depositors less and charge higher fees. Mergers and acquisitions serve as justification for branch closures, particularly in rural areas and working class community. We've seen that everywhere. We've seen it far too often in Ohio. We know that drives more consumers out of the banking system toward high-fee, predatory, non-bank financial companies like check cashers and payday lenders and fintech apps. Banking consolidation also means reduced access to credit for small businesses and increased borrowing costs. Fundamentally, it means that more power in our economy ends up concentrating in the hands of a tinier and tinier number of big bankers on Wall Street. We've seen over and over what a problem that is and the harm that the Wall Street business model does in places like Ohio, encouraging everything from inflation to outsourcing to lax safety. Look at East Palestine and the rail crash there just 10 months ago. We need strong action now from your agencies in this issue because these trends impose real and direct cost on Americans. With less competition, with less choice, with less access, it's more important than ever that we ensure banks are meeting the needs of their entire community. That's why I was encouraged to see that the FDIC, the Fed, and the OCC were able to come together last month and finalize the new Community Reinvestment Act. Thank you for that. CRA was enacted 46 years ago to ensure that banks meet the credit needs of all the communities in which they do business. CRA regulations last received a significant refresh in 1995. Since 95, the internet and mobile technology have fundamentally altered how Americans interact with the banking system. This modernization effort is critical to ensuring that banks are fulfilling the promise of CRA by serving and investing in their communities. I thank your agencies for working through this very complex rulemaking and delivering a final rule that we all believe will encourage banks to meet the credit needs of their entire community. In addition to CRA, the FDIC, Fed, and OCC also issued what's known as the Basel III in-game capital proposal. For anyone not steeped in financial regulation, that's an actual rule critical to protecting the economy. It's not the latest video game or Marvel movie. These capital rules represent the final and long overdue plank in the post-financial crisis overhaul of our regulatory capital framework, about ensuring that the largest banks have enough capital to address the risks that are unique to their institution and weather crises and emergencies and other sudden events that affect their banks. This proposal also recognizes the systemic importance of banks that are large, just not quite as massive as the Wall Street mega banks, banks like Silicon Valley before it collapsed. As we saw this spring, mismanagement, risky bets, and those banks still threaten the financial system. They also need to have enough capital to prevent this kind of threat to the economy we worried about earlier this year. Of course, we know that complaints that are coming, in fact, they started before we even saw the proposal. The industry's relentlessly attacked it with the same old tired arguments. Compliance will cost too much. We won't be competitive. We already have enough capital. We won't be able to lend to small business. We've heard it. You've heard it before. Be clear, the largest banks will need to redirect a tiny fraction of their enormous profits over a period of several years to get to the new capital levels. Every single bank that would be impacted by this proposal has the capacity to comply with the new capital levels, and extend credit to small businesses and working class and middle class families, all while remaining wildly, in most cases, profitable. I trust your agencies see these arguments for what they really are, the same old Wall Street whining, and that you'll deliver a strong capital rule, one that prioritizes the American people and their communities over quarterly profits of the banking industry. Finally, as we've discussed in this committee, illicit finance continues to pose a serious threat to the United States and the world. We've seen it most recently with funding Hamas was able to raise for its terrorist attacks on Israel. We see it every day in our communities with what's happened with fentanyl coming into our country. I implore your agencies to be vigilant when it comes to all the risks associated with illicit finance and the banking and credit union systems. You're all public servants. You're all responsible for making sure the financial system operates in a safe and sound manner and works for the American people. Don't let us down. Ranking Member Rounds.
Thank you, Chairman Brown, and thank you to our witnesses for appearing before us today. While this group comes before the committee every year, today's hearing feels particularly timely given the number and breadth of regulations being pushed through by our financial regulators. In the last few months alone, your agencies have put forth or finalized regulations and guidance that represent the biggest rewrite of banking regulations since the passage of Dodd-Frank. We have seen regulations on bank capital, long-term debt, resolution planning, the Community Reinvestment Act, debit card interchange fees, and climate risk management, just to name a few. These proposals collectively amount to thousands of pages, with the Community Reinvestment Act alone standing at almost 1,500 pages, nearly double the length of the entire Dodd-Frank Act. Moreover, none of these regulations exist in a vacuum. As legislators, my colleagues and I recognize the importance of actively considering all possible effects a law might have, including its impact on individuals and how we can mitigate unintended consequences. Therefore, we find it concerning that you have failed to consider how these rules will impact banks and businesses of all sizes, ultimately harming the American people. As a direct result of these regulations and proposals, banks will now spend their time complying with more Washington bureaucratic red tape instead of investing that time or resources into their local communities. Beyond overly burdensome compliance costs to financial institutions, we must recognize and emphasize that the costs of this rulemaking onslaught will ultimately be borne by small businesses and wage earners who are on a fixed income and rely on their local banks for loans and access to credit. Yesterday, Several of the witnesses before us received a letter led by Ranking Member Scott on the Basel III Endgame rule, which was signed by myself and 37 other Republican senators. We have heard from countless constituents from all walks of life about the harm they will experience should this rule go into effect. Our letter emphasized the detrimental impacts, such as limiting the availability of credit for housing in low and moderate income communities, severely restricting small business lending, and decreasing the retirement savings of hard-working Americans. Vice Chair Barr, you recently stated that, and I quote, "The proposal is projected to raise capital for large banks. This may result in higher funding costs, but this is only half the story." End of quote. However, I think the other half of the story is the millions of hardworking families who will be unable to achieve the American dream of homeownership, the tens of thousands of small businesses who will be unable to secure a loan, and the workers forced to stay on the job past retirement age because their pensions are providing less returns. What happens to them? We must remember that at the end of each regulation are real people, people who care about their safety and security of their families, including financial safety and security. Results matter. Since the Biden administration took office, it now costs the average American family of four over $700 more per month to live in this country. It's close to $1,000 in my home state of South Dakota. You are adding to that pain. This rule would put a strain on all institutions seeking to provide services that would help American consumers and businesses prosper, like many of those in my home state of South Dakota. Due to the scale and breadth of each of these proposals, I would support having a hearing dedicated to each and every one to understand the impacts that they will have. But seeing as my time today is limited, I wanted to call attention to another proposal where the regulators are operating well outside the mandates given to them by Congress. We've heard Federal Reserve officials, including Chair Powell, state as recently as last month that the Fed is not and will not become a climate policy maker. Yet our regulators are mandating that banks must engage in climate scenario analysis. Earlier this year, when the Fed conducted a climate scenario analysis exercise, officials stated that it would have no supervisory implications, but now banks are being told that they will be supervised to make sure they have such programs in place. So which is it? Not a single bank has failed because they have failed to account for climate risk. As Governor Baumann discussed in her dissent of the climate guidance, this action could ultimately lead to negative impacts on low-income communities who will have reduced access to capital. In your desire to worship at the altar of climate change, you are sacrificing the economic well-being and capabilities of hard-working Americans. Let me repeat, none of these regulations exist in a vacuum, and collectively, these rules paint a devastating picture for consumers, especially low and moderate income communities. At a time when all Americans are suffering from persistently high inflation caused by Bidenomics, the last thing they need is a bunch of Washington bureaucrats upending and rewriting a decade's worth of banking rules, which will only serve to restrict capital, harm the economy, and punish American families. I think you need to go back to the drawing board. Thank you, Mr. Chairman.
Thank you, Senator Rounds. Thanks for the service, all of you today. Vice Chair Barr, please begin your testimony.
Chairman Brown, Senator Rounds, and other members of the committee, thank you for the opportunity to testify on the Federal Reserve's supervisory and regulatory activities. Our banking system is sound and resilient. The acute stress that occurred in March has receded, and banking organizations continue to report capital and liquidity ratios above minimum regulatory levels. However, some banks have recorded sizable declines in the fair value of assets as interest rates have increased, putting pressure on tangible capital. These banks are actively managing the resulting set of risks, but these could take some time to address. Additionally, some banks that have high reliance on uninsured deposits are using more expensive funding sources to manage their liquidity. Looking forward, preserving a sound and resilient banking system requires continued attention to address identified vulnerabilities and vigilance to changing conditions. Starting with supervision, since the bank failures earlier this year, the Federal Reserve has been moving forward with ways to improve the speed, force, and agility of supervision as appropriate. In considering improvements to supervision, we are very mindful of the differences in size, risk, and complexity of supervised institutions, and the importance of maintaining the strength and diversity of banks of all sizes that serve communities across the country. Furthermore, supervisors have been focused on addressing material risks presented by the current economic environment. This includes conducting targeted reviews at banks exhibiting higher interest rate and liquidity risk profiles, and monitoring for potential credit deterioration, particularly within the consumer and CRE lending segments. A key component of this resilience is capital. Capital allows banks to absorb losses on those assets while continuing to serve households and businesses. In the global financial crisis, the effects of woefully undercapitalized banks had a devastating impact on our economy and resulted in the worst recession since the Great Depression. It took 6 years for employment to recover. More than 10 million people fell into poverty, and 6 million families lost their homes to foreclosure. And these costs occurred even with substantial support from the government. In the years following the global financial crisis, the board adopted a set of capital reforms, which greatly strengthened our banking system, and capital ratios of the largest banks have more than doubled since 2009. At the same time, the U.S. banking system has grown from $12 trillion in assets in 2009 to $23 trillion today, while showing strong profitability and overall market valuation. U.S. banks have enhanced their position as leaders in global capital markets activity. Importantly, these reforms have served the U.S. economy well. Our economy has grown substantially with the continued support of robust lending from a stronger banking system. The reforms to the capital requirement framework that the banking agencies proposed earlier this year are the last stage of these post-crisis capital reforms. It has long been recognized that work remains to improve how banks measure risk, which is critically important because the riskier a bank's assets are, the more capital it needs to protect against those risks. The proposed rules would apply to banks with at least $100 billion in assets, fewer than 40 of the over 4,000 banks in our banking system. Community banks would not be affected by this proposal. The effects for each bank would vary based on its activities and risk profile. Notably, the increases would be the most substantial for the largest and most complex banks, the GSIBs, and the bulk of the estimated rise is attributed to trading and other non-lending activities. The comment period is an important part of the rulemaking process. We are providing the public nearly 6 months to review the proposal so they can provide meaningful comments. We welcome all comments that provide the agencies with additional data and analysis to help ensure the rules accurately reflect risk. I would also like to briefly highlight our long-term debt proposal. In August, the agencies proposed a rule that would expand long-term debt and resolution planning requirements to additional large banks. The proposal's goal is to increase the potential options available for resolving depository institutions and to enhance overall financial stability. Importantly, the proposed requirements would be calibrated at a lower level relative to the largest and most complex banks. As with the capital rules, I would like to emphasize that these are proposed rules, and we look forward to hearing the public's comments. Thank you. I'm happy to take your questions.
Mr. Gruenberg, welcome.
Thank you, Mr. Chairman. Chairman Brown, Senator Rounds, and members of the committee, I'm pleased to appear at today's hearing on oversight of financial regulators. The U.S. banking industry has proven to be quite resilient despite the period of stress earlier this year. In the second quarter of this year, key banking industry measures of performance remained favorable. Net income remained high by historical measures. Asset quality measures were stable, and the industry remained well capitalized. However, banks reported lower net interest margins and higher funding pressures for a second consecutive quarter. Higher market interest rates caused market values for debt to generally fall during the second quarter, resulting in higher unrealized losses on securities, an issue that became apparent earlier this year. In the second quarter, uninsured deposits declined by 2.5%. That's a significant slowing from the 8% decline that we experienced in the first quarter. By contrast, insured deposits increased by 0.8% during the second quarter of this year. In the second quarter also, depositors sought higher yields, often at non-bank financial institutions, particularly money market mutual funds. Many banks have increased deposit rates to compete, resulting in a higher cost of funds. The banking industry continues to face significant downside risks from the effects of inflation, rising market interest rates, and geopolitical uncertainty. The economic outlook remains uncertain despite relatively solid growth and low unemployment so far this year. These risks could cause credit quality and profitability to weaken, loan growth to slow, provision expenses to rise, and liquidity to become more constrained. Commercial real estate loan portfolios, particularly loans backed by office properties, face challenges when loans mature as demand for office space remains weak and property values continue to soften. Banks have tightened underwriting standards over the past year across a range of household and business loans, and they may continue to tighten further. The failure of 3 large regional banks this spring demonstrated the risk to financial stability that large regional banks can pose. The FDIC, along with the Federal Reserve and the OCC, proposed rulemakings that would enhance the resilience and improve resolvability of large regional banks. These include a long-term debt proposal that would require a layer of loss-absorbing capacity at large banks to take losses before uninsured and insured depositors, thus decreasing the incentive for uninsured depositors to run and mitigating the need for a systemic risk exception in a future failure. In July, the banking agencies issued a notice of proposed rulemaking for Basel III. The proposal is a continuation of the federal banking agency's efforts to revise the regulatory capital framework for our nation's largest, most systemic financial institutions following the global financial crisis of 2008. Notably, it does not apply to community banks. The NPR would make important changes to address capital weaknesses identified in the 2008 financial crisis, enhance the resilience and stability of the banking system, and enable the banking system to better serve the U.S. economy. In addition, the FDIC is undertaking a comprehensive review of its supervision program with a focus on interest rate risk, unrealized losses on securities and loans, uninsured deposits, rapid growth, and the need, when necessary, to escalate supervisory matters and take actions to compel compliance. In October, the banking agencies adopted a final rule to strengthen and modernize the Community Reinvestment Act. In closing, if I may, I'd like to address a recent news report regarding incidents of sexual harassment and misbehavior at the FDIC. I am personally disturbed and deeply troubled by this report. The FDIC is conducting a comprehensive review, including engaging an independent third party, to ensure that we understand the nature of these issues and take all appropriate actions to address them. Let me underscore, I have no higher priority to ensure that all FDIC employees work in a safe environment where they feel valued and respected. That concludes my statement, Mr. Chairman.
Mr. Harper, welcome.
Chairman Brown, Senator Rounds, and members of the committee, thank you for the invitation to discuss the work of the National Credit Union Administration. My remarks here will focus on the state of the credit union system and 2 legislative requests. During the last year, the credit union system has largely remained stable in its performance and resilient against economic disruptions. At the end of the second quarter, the system had $2.2 trillion in assets and $1.5 trillion in outstanding loans. And the system's aggregate net worth ratio was 10.6%, well above the 7% well-capitalized leverage ratio required by statute. The Share Insurance Fund also continues to perform well, with no premiums currently expected. And to better position the fund's liquidity in the current economic environment, the NCUA has increased overnight investments to $4 billion. Nevertheless, we should pay attention to several emerging issues and trends. Net charge-off ratios at credit unions have risen over the last year, and annualized returns on average assets have declined slightly. Increasing liquidity, interest rate, and credit risks have also led to a drop in composite Camels Code ratings to 3s, 4s, and 5s. Assets in Camels Code 3 institutions, for example, increased sizably in the second quarter, especially among those complex credit unions with more than $500 million in assets. Ultimately, the data from the first half of the year reveal a tale of 2 types of credit union members. The first type are those who have shifted their share savings deposits to share certificates to capitalize on better rates. In all, time deposits have increased approximately 70% during the last year. Unless carefully managed, this switch from low-paying to higher-yielding accounts can expose credit unions to greater interest rate and liquidity risks. Delinquency rates on most types of loans are also rising, and that leads to the second type of members, those with growing financial difficulties. Credit card balances are elevated and higher than what we should expect in the typical second quarter. Additionally, balances on home equity lines of credit and other second liens have increased by 1/3 during the last 4 quarters. In some cases, those increases may indicate household financial stress. Consequently, credit unions must carefully manage their credit risks going forward. Early intervention at the onset of a delinquency can improve the credit union member's financial footing and prevent a charge-off. The current economic environment also underscores the importance of the NCUA's Central Liquidity Facility, or CLF for short, as a liquidity shock absorber. As of September 30th, the CLF had $19.8 billion in lending capacity. This figure contrasts sharply with 9 months earlier when the CLF had $27.5 billion in lending capacity. This sizable contraction resulted from the expiration of temporary statutory enhancements that facilitated the agent membership of corporate credit unions. To address this expiration and growing liquidity risks within the system, the NCUA board has unanimously requested that Congress restore the CLF's corporate credit union and agent member provisions, which the Congressional Budget Office has scored at no cost to the taxpayer. Additionally, it remains the policy of the NCUA board to restore the NCUA's authority to examine and supervise third-party vendors. The Government Accountability Office, the Financial Stability Oversight Council, and the NCUA's Office of Inspector General have all recommended this reform. Vendor authority would allow the NCUA to gain a better understanding of all the risks present in the credit union system and close a growing regulatory blind spot. And such legislation would reduce the compliance costs, due diligence burdens, and future share insurance fund premiums for credit unions. In sum, the NCUA stands ready to address the impact of the evolving risks within the credit union system, including growing liquidity, interest rate, and credit risks. The NCUA will also continue to coordinate with other financial regulators to ensure the overall resiliency and stability of our nation's financial markets. That concludes my remarks. I look forward to your questions.
Thank you, Mr. Harper. Mr. Sue, welcome.
Thank you, Mr. Chairman. Chairman Brown, Senator Rounds, members of the committee, I'm pleased to testify today to provide an update on the activities of the Office of the Comptroller of the Currency. Despite the significant market stresses earlier this year and the challenging interest rate environment, the overall condition of the federal banking system is sound. OCC-supervised banks in the aggregate have strong levels of regulatory capital and healthy levels of profitability while maintaining sufficient liquidity buffers. The OCC engages directly with the institutions it supervises to ensure that they are being vigilant in managing their risks. Our recently released Bank Supervision Operating Plan for 2024 summarizes the agency's examination priorities for next year and highlights asset liability management, credit risk and allowance for credit losses, cybersecurity, operational risk, and consumer compliance risk, among others, as key areas of focus. My written statement provides an update on the agency's work advancing its key priorities of guarding against complacency, reducing inequality, adapting to digitalization, and managing climate-related financial risks at the largest banks. I will highlight some of these efforts here. Despite the relative calm in the market today, the OCC has urged the banks it supervises to stay on the balls of their feet with regards to risk management. To assist banks, the OCC has updated guidance for the industry. For example, in response to increasing risk in commercial real estate, the OCC and other regulators published the Policy Statement on Prudent Commercial Real Estate Loan Accommodations and Workouts, which updates existing interagency supervisory guidance on CRE loan workouts and reminds banks to work prudently and constructively with creditworthy borrowers during times of financial stress. Ensuring that financial services are offered responsibly and fairly takes continued effort and vigilance by banks, regulators, and other stakeholders. On October 24th, 2023, the federal banking agencies issued an interagency final rule implementing the Community Reinvestment Act. The CRA was enacted in 1977 to prevent redlining and to encourage banks and savings associations to help meet the credit needs of the communities in which they operate, especially low and moderate income neighborhoods and individuals. The final rule modernizes the CRA by recognizing banking activities that take place beyond physical branches and ATMs, being significantly more data-driven and objective, and providing for greater transparency. It strengthens the CRA by addressing concerns related to grade inflation and CRA ratings, and by better incentivizing CRA lending and investments in LMI communities. The rule tailors evaluations and data collections to bank size so that community banks do not have additional burdens. Banks' relationships with third parties, including financial technology companies, continue to expand. The use of third parties has significant potential benefits, but poor third-party risk management can hurt consumers, weaken banks, and contribute to an unlevel playing field. Recently, the OCC and other regulators jointly issued interagency guidance on third-party relationships risk management, reminding banks of their responsibility to operate in a safe and sound manner and in compliance with applicable laws and regulations, regardless of whether their activities are performed in-house or outsourced. The OCC also recognizes the considerable interest by the banking industry in artificial intelligence. To date, banks have generally approached machine learning and AI cautiously across a range of use cases. The potential benefits of more widespread adoption of AI are significant, but so are the risks, which we expect banks to continue to manage appropriately. In the digital asset space, attention is shifting from crypto to the tokenization of real-world assets and liabilities. In contrast to crypto, tokenization is driven by solving real-world settlement problems and can be developed in a safe, sound, and fair manner. Next February, the OCC will host a public symposium on tokenization to take stock of developments, help enable strong foundations, and promote public discussion. This fall, the OCC, along with the Federal Reserve and FDIC, approved principles for climate-related financial risk management for large banks. The principles are focused exclusively on risk management and do not tell bankers what customers or businesses they may or may not bank, but clarify how large banks can maintain effective risk management and keep their balance sheets sound so they can continue to be a source of strength to their customers and communities through a range of severe weather scenarios. In closing, the OCC continues to be engaged in a range of efforts to ensure that OCC-supervised banks operate in a safe, sound, and fair manner, meet the credit needs of their communities, treat all customers fairly, and comply with laws and regulations now and into the future. Thank you. Happy to take a question.
Thank you, Mr. Zhu. Chair Gruenberg, start with you. Yesterday, you mentioned this, reported that pervasive sexual harassment, misogyny, lack of accountability have created a toxic environment for female bank examiners. These allegations, to say the least, are troubling. When the FDIC IG highlighted these problems More than 3 years ago, the FDIC agreed to changes but disagreed that its anti-harassment program was inadequate. What are you doing now to address these problems?
Thank you, Mr. Chairman. As I indicated, the report yesterday was deeply disturbing and troubling, and it's quite clear that we've had employees at the FDIC subjected to horrendous experiences that simply are unacceptable and can't be tolerated. And it's really going to be incumbent on the agency to take all actions necessary to come to grips with this and to address it effectively. We are engaging a third party, an independent third party, to do an agency-wide review, both of Washington as well as our regional and field offices, to inform us on the nature of the challenge here and how we may be able to address it effectively. I think the core issue here, if I may say, we have appropriate policies and procedures in place. The issue is it's really on management to instill the confidence in our employees to utilize those procedures and policies in a way that they can feel safe and secure and that their information is kept confidential. And that's not an easy thing to do. I mean, we can work on the policies and the procedures, but on the part of management, giving employees the sense of confidence that they can actually utilize these mechanisms to protect themselves if they're treated improperly, and also to have processes to hold individuals accountable who engage in misconduct. That's a core challenge that we are going to work on, devote all the resources of the agency to try to address. We will be transparent as we proceed with this process. We'll report out to you and glad to keep you informed as
Thank you.
As we work.
Perhaps, as you said, perhaps not an easy thing to do, but we expect you to create a safe and welcoming workplace for all employees, examiners, and others. It's also why we must confirm the FDIC Inspector General, who was marked up in this committee last week. Second question for Vice Chair Barr. Capital allows banks to lend in good times and bad. It prevents taxpayers from having to bail out Wall Street banks, again, that take on too much risk. Briefly, why is this capital proposal needed?
Thank you, Mr. Chairman. I agree. Capital is key to a resilient banking system and to a thriving economy. We need our banking system to serve households and businesses. Strong capital helps them do that, as you said, in good times and in bad. Capital is key to preventing financial crises and reducing their costs. This proposal only applies to the largest banks, fewer than 40 out of the more than 4,000 in this country. The proposal focuses on having stronger capital rules for trading and other non-lending activities where banks have had large losses. The proposed changes for credit and operational risk associated with credit are very small compared to the current rules. Overall, the proposal makes our capital system more consistent, more transparent, and more risk-sensitive. That said, we recognize that the rule may not appropriately capture all risks. We welcome all comments on all aspects of the rule. We'll take these comments seriously to improve the rule going forward.
Thank you, Mr. Vice Chair. This spring, we saw that the weakened rules demanded by the Trump administration resulted in 3 of the 4 largest bank failures in our nation's history. Starting with you, Comptroller Sue, how has OCC revised its I'll ask each of you, but I'll ask them all and then please answer in the last few seconds. How has OCC revised its supervisory approach to address the gaps that the prior administration created in the bank failures earlier this year exposed? Chair Harper, has NCUA implemented any changes in its approach to supervision in response to those bank failures? And then Chair Gruenberg of the FDIC and Vice Chair Barr at the Federal Reserve. And since I'm over my time, be as brief as you can. Thank you.
Sure. At the OCC, we've got strong processes in place. None of the bank failures that happened earlier this year were national banks. That being said, we've carefully reviewed all of the postmortems of those and identified areas where we can strengthen the agility and the speed with which we supervise and the intensity of our supervision.
Briefly, we've increased our assessments of liquidity within individual credit unions. We're also looking at commercial real estate, as we know that that's a rising concern. Fortunately, we had recently implemented our risk-based capital rules, which are increasing the capital to strengthen the system. And lastly, within the credit union system, 90% of deposits plus are insured, and so we did not see the instability necessarily that we're seeing in the banks.
Mr. Gruenberg.
Thank you, Mr. Chairman. We learned some hard lessons from the experience earlier this year. We have issued guidance for our examiners focused on some of the key lessons from that experience: managing interest rate risk, concentrations of unrealized losses on loans and securities, uninsured deposit concentrations, rapid growth, and the need, when necessary, to escalate matters in regard to an institution and to compel compliance if an institution is not responsive.
Mr. Barr.
Thank you. We've been focused on improving the speed, force, and agility of supervision as appropriate for the institutions we supervise. We're working on ensuring that we have appropriately intensified our supervision of the highest risk firms. We're working to make sure that the assessment of risk appropriately influences supervisory activities. We're making sure that issuance of supervisory findings and enforcement actions are timely and that they provide bank management and the board of directors with the necessary information and incentives to remediate deficiencies quickly. And we're working to align the intensity of supervision with the institution's size, complexity, and business model, appropriately addressing rapid growth, for example, and other risk factors. As with other agencies, we're currently focused on issues such as interest rate risk, liquidity risk, risk to the credit profile of institutions, particularly CRE office risk, and also cyber risks.
Thank you. Senator from South Dakota, Senator Rounds.
Thank you, Mr. Chairman. Mr. Chairman, as you've indicated earlier, yesterday the Wall Street Journal did publish a concerning article about the toxic atmosphere at bank regulator FDIC. I'd like to enter a copy of this article in the record.
Without objection. Without objection. So ordered.
Thank you. Chair Gruenberg, were you aware of these allegations before the publication? A simple yes or a no would do.
As a general matter, no, Senator.
After the publication of this report yesterday, I understand, as you have stated before the committee a few minutes ago, that you have informed the FDIC staff that the FDIC would hire an independent firm to conduct an assessment of these concerning allegations. It is also my understanding that there may be additional press reports coming as well. Are you going to be the object of any of these future reporting issues on this matter?
For the in terms of the agency's work, not that I'm aware of.
You personally, Mr. Gruenberg, are you going to be the object of any of these reports?
For news reports?
Yes.
I mean, I can't speak to that. You really have to speak to the news organization, Senator.
Thank you, Mr. Gruenberg. Vice Chair Barr, as I detailed in my opening remarks, I do have deep concerns about the impacts that the Basel III Endgame proposal will have on consumers and small businesses across the country. In fact, Vice Chair Jefferson asked at the time of the proposal, and I'll quote, "Can you give me a sense of how and to what degree these higher capital requirements could constrain a bank's ability to lend to businesses and individuals? I'm very concerned about these impacts," end of quote. I echo Vice Chair's concerns and have yet to see any proof that this rule would not be incredibly harmful to businesses and individuals. My question for you is, how many days did you give your colleagues to review your holistic review before providing them the rulemaking?
Senator, I don't have the exact number of days in my head. We can get back to you on that. They had quite a long period of time to review the proposal, to provide input on that proposal.
Yeah, I'd appreciate it for the record as to how much time that you provided them on that.
I'd be happy to provide that. It was an extensive period of time for review of the proposal before its issuance.
Okay. When will this holistic review be released to the public, or at least to this committee?
Senator, I was referring to the proposal that we put forward. The proposal itself is what goes through the normal notice and comment rulemaking process. The holistic review preceded that. It's what my predecessor did. It's what the person before that job did. It's a chance to wrap our arms around the whole system before deciding whether to move forward with a proposal. The proposal follows the normal notice and rulemaking comment, the normal engagement with board members, normal engagement from the public.
So you're
We
saying
very much
that-
welcome
that-
those comments.
That holistic review is out already?
The holistic review preceded the work to engage in any
And
public
is
proposal.
it public today?
The holistic review is an internal review
And it's
that
not
I
public.
undertook in order to engage in this activity. I published remarks saying that as a result of that review, I thought the overall framework was sound.
But wouldn't that have been something that would have been shared with other members?
In
Holistic review?
I'm sorry, with other members of the
Wouldn't other
board.
members of the board have had a chance to look at that review?
Other members of the board have a normal chance to engage with the rulemaking process.
Well,
I've
no,
had many
so
discussions.
you didn't share this holistic review with other members of, other
had-
members didn't see it?
I had many discussions with other members of the board about this capital rule and about my views on the capital process overall. So I have been engaging with my fellow board members quite extensively.
So you did not give your colleagues a copy of or give them an opportunity to review your holistic review before providing them the rulemaking?
There is not a document that is the holistic review, sir. That is not the result of that process. The work that's the result of that process is a decision about whether to move forward with a proposal. That proposal is the Basel III endgame proposal that we put forward and the long-term debt rule that we put forward. Those proposals are fully public, and I've been engaging with...
Without a written analysis?
No, they contain a detailed written analysis in both cases as part of the proposal.
The detailed analysis then is, what you're saying is the rulemaking itself contains the detailed analysis?
Correct.
So the detailed analysis as a part of the rulemaking comes out at the same time the rulemaking does, without any preliminary data being laid out before the rest of,
Sir, the rulemaking has followed the normal administrative rulemaking process, which is to include in the proposed rule all the analysis that supports the rule. We followed that exact same process here. It's the process we've used for rulemaking during the Fed's history. So it's no different process. It's the same process that we always follow.
thank you. My time has expired. Thank you, Mr. Chairman.
Senator Reed of Rhode Island is recognized.
Well, thank you very much, Mr. Chairman. And I would note that the Federal Reserve recently approved synthetic risk transfers in which banks use derivatives to reduce their capital requirements by shifting risk of losses onto private equity funds and hedge funds. Having survived 2008 and Dodd-Frank, when I hear derivative, I get nervous. When I hear synthetic, I get very nervous. Mr. Barr, what are the risks to the financial stability of banks that are permitted to engage in these synthetic risk transfers on a significant scale, and what guardrails are appropriate to protect the financial system and ensure that we don't relive the past?
Thank you, Senator. It's an important question. We looked carefully at these sets of transactions. The transactions are different from transactions that we permit by rule under the existing authorities to offset credit risk that banks might face. We wanted to take a careful and cautious approach with respect to these transactions. So we have approved them on a case-by-case basis, subject to limitations. We're going to wait and see how those instruments perform. If they perform as intended, then they might be more generally available. If we see risks arising in those transactions, then we would limit their use for capital mitigation.
How much visibility do you have in the private equity and hedge funds that are involved in these transactions?
We have very strong visibility into the bank side of the transaction. That is, how the bank engages with third parties with respect to these risks. We'll be monitoring those risks. We have, of course, much less visibility into hedge funds and private equity funds. That is a longstanding issue in supervision.
Well, I think you have to have a really good perception of both sides of the transaction to conduct these, because there's a possibility that a private equity firm could be undercapitalized or mismanaged, and the transactions would fail.
In these particular transactions, Senator, the transaction that we approved, the cash is actually provided up front to the bank, and then it diminishes over time as the credit continues to perform. So in these particular transactions, I agree with you that that's a general concern, but in these particular transactions, the cash is actually provided at the beginning of the transaction rather than at the end of the transaction.
Thank you. Ms. Gruenberg and Mr. Wu, do you see any risks of financial system in these types of synthetic risk transfers?
I think there is considerable uncertainty, and we need to approach it with great caution and attention, Senator.
Thank you. Mr. Wu? Sue?
I agree. They do require heightened attention, especially when risk transfer is thought of as risk elimination, which it is not. However, when done appropriately in a safe and sound manner with controls, it can help to be part of an effective risk management program, but that does require a careful look.
Let me turn to another situation, the rent-a-bank situation, in which banks partner with non-banks to provide deposits and loans. And these arrangements can facilitate evasion of state usury limits and other important consumer protections. In fact, I think that's why they have these rent-a-bank arrangements. Mr. Gruenberg and Mr. Sue, can you provide an update on what you're doing with respect to these rent-a-bank situations? Mr. Gruenberg?
Yeah, thank you, Senator. You raise an important risk management issue for banks. These third-party relationships carry a lot of risk. And when a bank partners with a third party and that third party is carrying out the services of the bank, it's as if the bank itself is doing that directly and the bank is accountable for it. So the management of those third-party relationships are really quite important and carry a lot of risk with it. The challenge here in part is the ability of states to export their interest rates to other states and circumvent the usury laws. And that's something we're giving some attention to.
Okay, Mrs. Sue, quickly.
Yes, so predatory lending has no place in the national banking system, whether done directly by banks or in partnership with fintechs, and we made sure of that.
Thank you very much. Thank you, Mr. Chairman.
Thanks, Senator Reid. Senator Tillis of North Carolina is recognized.
Thank you, Mr. Chairman. Mr. Gruenberg, in response to Senator Round's question about whether or not you had any knowledge prior to the publication of the report, you said, as a general matter, no. Should I read anything into that, or did you not know about any of these activities before the report?
Yeah, I did not know about the individual cases. I wouldn't in the normal course of things,
Okay,
Senator.
thank you. Mr. Barr, I think the Fed, the thing I've admired about the Fed, I think the thing that the industry has admired about the Fed is it has a long history of consensus-driven decision-making. You clearly, at this point, do not have consensus on some of the notice of public rulemaking, the endgame for Basel III. I know of maybe some questions or concerns that Mr. Jefferson have raised, Mr. Powell, and others. Do you intend to move forward with this if you don't have consensus among the board?
Thank you, Senator Tillis. I'll be working to achieve broad consensus of the board in a
what if
final
you don't?
rule. As with all rules, we try very hard to get as close to full consensus. I would like to get broad consensus. I don't know whether I'll be able to get full consensus.
And what would broad
on the board.
consensus look like?
A broad consensus would be that most of the board believes that this is an appropriate step. You know, most of the activities that we've put forward over the last year and a half since I've been on the board, not quite a year and a half, but 15 months, most of those have been full consensus items. We've had about 50 substantive supervision and regulation matters come before the board. Almost all of them, every board member has voted in favor of. I very much appreciate and value the collegial nature of the board and the consensus.
Well, I hope you will. I want to, if time allows, I want to get to some of the areas, particularly the cost and putting us at a competitive disadvantage. But I want to move on to something else. The chair talked about, and this has been suggested before, that Silicon Valley Bank and Signature Bank failed because of Senate Bill 2155, bipartisan regulatory reform that we implemented in the Trump administration with the support of Democrat members in this committee. Have we passed a law since Silicon Valley Bank failed that's increased your supervisory authority?
No, Senator.
No. But you did say you've stepped up and you've intensified supervision. I'm assuming you did part of that by using the optionality in the Senate Bill 2155 to actually increase your MRAs and MRIs. Is that accurate?
As I've indicated in previous testimony, we have the legal authority we need to engage in this.
I guess it's just odd to me to think that we had a bill that has been more than once pointed to as a reason for the failure. We haven't changed a line of regulatory legislation. You're intensifying your supervisory functions, which you should if they're founded on banking activities that you think represent a risk. So I just don't get it. You had that optionality. One of the reasons why I think Signature failed is because someone was asleep at the switch in the supervisory function and a management failure. But I just can't let that go unchecked because you are stepping up. And it relates to another question I have. I sent a letter back in September when there was a news report talking about 7 different financial institutions and their dramatically increased, specific institutions, dramatically increased MRAs and MRIs. I can't imagine those 7 banks just went to the press and said, "Hey, we're getting a lot more. We're getting a lot more impact." That sounds like someone from the Fed or the supervisor had to have leaked confidential supervisory information. We copied you on the letter, but can you tell me whether or not there's any investigation underway to figure out how that information got out? I can't imagine it came from the industry. It just doesn't make sense for any reporter to have that specific information on 7 institutions to serve as a basis for a report.
Senator, I also was upset by that article. I didn't think that it was appropriate. We do have strict rules on confidential supervisory information. I'm not aware of the source of that article, but I do find it upsetting.
Yeah, and I think somebody needs to be tracked down and terminated for doing it. Mr. Chair, I'd like to seek unanimous consent to introduce this article that was written by my alma mater, by PricewaterhouseCoopers, the Financial Services Update, Basel III Endgame, outsized operational risk impact. I've only got
Objections ordered.
Thank you. I only got 20 seconds left, so we're going to have to submit questions for the record. I believe in its current form, and that's why I hope that you can find consensus. In its current form, I think we're going to disadvantage banking institutions in terms of global competition. I think the operational risk is outsized, and we've got a lot of questions, and I don't have any more time. Thank you.
Senator Tester of Montana is recognized.
Yeah, thank you, Chairman, Ranking Member, and I want to thank everybody for testifying today. Marty, the article that came out in the paper is damning, very damning. I guess the question is it says in this article that folks were demoted, but nobody was fired. By the things, if true, the stuff in here, do you see them as a fireable offense?
You really have to look at the individual cases, Senator. We have had cases in the past where individuals are separated from the agency. We've had cases in which other disciplinary actions short of separation have been utilized. It depends on the facts of the case and the law, and you really have to look at the individual cases.
I would, and I understand that, but I will tell you that this is so pervasive that 20 women have quit. I know you got a big agency, so that might not be a lot, but man, I think if you're going to change behavior, the best way to do it would be to deal with these folks very severely. And I know you need probably more regulators than you have now, but the truth is that what was represented in that Wall Street Journal article is absolutely, as you already pointed out, unacceptable. I want to talk about Basel. It's the same line of questions as has been talked about here from both sides of the aisle. Look, I'm concerned about small businesses because Montana's a small business state. they have to have access to capital. These rules don't affect any banks in Montana, but they do affect the big guys that affect Montana, okay? And if you look at our system, it has worked incredibly well, especially when you compare it to what folks in other countries have access to. But I do have some concerns about the proposed changes and how its impact will be on workers and households and small businesses, access to credit, and overall vibrancy of our capital markets. So the question is how are you guys, and I'm talking Barr and Sue and Gruenberg, how are you evaluating the impact of these proposal changes on the consumers? Go ahead.
Thank you very much, Senator Tester. First of all, let me just say we share your same concerns. We want a capital system, a banking system that works for households, that works for businesses, works for small businesses around the country that are really the lifeblood of their communities. The way we've analyzed this rule, we do not believe that this will have significant negative effects on small businesses. The credit provisions in the rule are quite similar to existing binding provisions. And we welcome comment if we can improve the rule in that regard.
We will stick with you, Michael. And so you're in the process of taking in comments that go until the middle of January, correct, or end of January, somewhere in that?
That's correct, January 16th.
And so, can you tell me, have you looked at those comments yet? And then do any of them talk about the issue that I'm talking about how this is going to affect consumers?
But we expect most comments to come in mid-January, but we already have heard in the public discourse a concern in this regard, and we're paying very, very close attention to that. And as I said, if there are areas that we can improve the rule, we're very open to doing that.
And so you're open to improving, AKA rewriting the rule if the comments reflect that?
We very much welcome all those comments. We have to look at the substance of them, but we want to make sure the rule works right for households and businesses. And if we need to make adjustments to the rule to make sure that that's the case, we will do it.
Okay, so not to beat this horse anymore, but I will just tell you that from a small business standpoint, if this rule doesn't work, it's going to raise hell with the economy of my state. So that's all I need to tell you. I have also had a conversation about how potentially this could push activities into the non-bank sector that's not regulated. And I'll stick with you, Michael, because I don't have enough time to go down the line. How do you consider those larger impacts based off the rule that's going to be put out? Because as most of us at this side, all this side, I mean, we remember what happened in 08 pretty vividly. Jack referred to it. Could you tell me how you weigh this stuff out? Because if we're pushing stuff to the non-bank, and I'm sorry I'm over time, but if we push this stuff to the non-bank, that is not a good thing. Talk to me.
Thank you, Senator Tester. I share your concern. It's an issue that we take very seriously. We'll continue to take seriously as we get in comment. If it looks like in the mix of things that we're increasing risk, we obviously wouldn't want to do that. We want to make sure that we're reducing risk with the capital proposal. We want to make sure we have good, strong regulation of the non-bank sector, and we want good, strong rules in the banking sector because we need a vibrant banking sector to support the American economy.
It is absolutely critical. Without access to capital, we are dead in the water. Thank you, Mr. Chairman.
Thank you. Senator Brett from Alabama is recognized.
Thank you, Mr. Chairman. Thank you all for being here today. Since your last appearance before this committee in May, banks of all sizes have yet again proven their strength and ability to withstand unexpected volatility. In fact, quickly, I would like to just go down the row and each of you please answer with yes or no. Do you believe that the U.S. banking system at large is strong? Vice Chair Barr, we'll start with you.
Yes, I do.
Yes, Senator.
Yes.
Yes.
Great, thank you. So for the record, all of you believe the U.S. banking sector is strong. Yet, over the last several months, we've seen a wholesale attempt to fundamentally alter our banking system. Not only do your agency's recent proposed rules undermine the proven strength of our banking sector, but they risk making it weaker. And it is Main Street America that will ultimately be punished. I have spoken directly with dozens of banks and credit unions of all sizes. It is clear that your proposed rules are so wide-reaching that they leave no financial institution untouched. Even more concerning, it is apparent that the lack of effort from you as regulators to engage these institutions is startling. Along with the absence of any stated rationale for making these key decisions, I want to start with the Basel Endgame rule. Let me follow up on a question that Senator Rounds asked. Vice Chair Barr, how long did your fellow board members have to review the proposed rule prior to it being issued?
They had an extensive period of time. I'll get you the exact number of days, but it was many, many weeks. I believe, well, anyway, I don't want to guess. I'll tell you the exact number of days for the record, but it was many weeks.
Many
to
weeks.
review.
So many weeks would be longer than 2 then.
Correct.
Okay, so your colleague, Governor Cook, testified in this committee on July 12th that she had not yet seen the Basel III proposal. So that just 2 weeks later, the proposal was rolled out. So does that mean that your colleagues had less than 2 weeks to actually review the rule, or was she mistaken in that testimony?
Each governor can decide how much they want to engage in the process.
But she had been
They're
given the
available.
opportunity and then chose not to, I guess?
I can't speak specifically to what Governor Cook chose to do, but every governor was given the opportunity to meet with staff and to be briefed on the proposal in detail.
Okay, well, the rule assumes that banks are significantly undercapitalized for operational risk, but yet cites no evidence to support this assumption. Not only are these risks already accounted for in stress testing, but the new standardized approach is not tailored to the varying business models of various banks. Vice Chair Barr, would you say you've done a thorough analysis to understand the impacts of the proposed operational risk requirements and what they would have on availability of mortgages, on small businesses, small business loans, and retail credit to consumers?
Thank you, Senator. The analysis goes into detail on the preamble on these items. As I suggested, with respect to credit risk, whether that's for mortgages or small businesses or consumers,
Go ahead.
sorry, just the combination of the credit risk proposal and operational risk is very, very small in relation to current rules.
So obviously that is a yes. The way that I view this, the Basel proposal is over 1,000 pages with fewer than 20 pages dedicated to actual economic analysis. Also absent is a study of the combined impacts of other concurrent proposals, like the long-term debt proposal and debt-free caps, despite the fact that each of these proposals will actually clearly overlap. It raises a question. If you're unable to do a cumulative impact and put that actually in the rule, or are you just unwilling to do that?
We continue to study impacts of the rule. We welcome public comment, both on the long-term debt proposal and on the capital proposal. If analysis is coming from the public that is helpful, we're happy to include that
I think
in
it's
improving the
critically
rule.
important, and I'm almost out of time. We have to look at how these things work together because it is clear that there is a trickle-down effect, and I think we've got to do a better job of stating that. Mr. Barr or Chair Gruenberg, what is the cumulative impact study, and have you conducted that and actually put that in writing?
The quantitative impact study is a study that we did prior to release of the rule. It was done by the board in 2021.
Okay.
That was included in the proposal, and now, in addition to that, we're updating that quantitative impact study with a new study that will gather information to make sure we have the most up-to-date information as we proceed to finalize the rule.
And last, before I run out of time, do you plan to grant a comment period extension for the proposal on long-term debt and resolution planning?
That is a simpler rule, a pretty straightforward rule compared to the Basel proposal, but if there are concerns
I
that
think
people
there
need
are
more
concerns,
time,
absolutely. And
we're happy to consider such matters.
well, thank you so much. I hope that you will do that. Look forward to it. Thank you.
Senator Cortez Masto from Nevada.
Thank you. Thank you. Gentlemen, thank you for being here. Chairman Gruenberg, let me start with you. Thank you for reaching out to talk about the concerns. I think we are alarmed by what we are reading in the Wall Street Journal regarding the sexual harassment at FDIC. So I appreciate you reaching out. I also appreciate the fact that you've talked here today about doing a comprehensive review, a independent third-party agency-wide review. Thank you for that. I guess my question is, one, how long will that review take? And two, in the meantime, what do employees do? if they want to come forward and feel confident in coming forward with a complaint.
That work is just beginning, Senator. I think we would hope to get it done as soon as possible, 90 days or less if we can, but we're just starting on that. In the interim, I mean, we do have a range of processes that employees can take advantage of if they want to report some experience that's problematic. But we obviously want to look at that and see how effective that is and how we can make the system give employees as much confidence as possible to be able to utilize it effectively.
Thank you, and I look forward to working with you as we follow up on this review to make sure this is addressed. So I appreciate the comments today. Let me jump to the Community Reinvestment Act. I want to say congratulations on the new CRA. First question is, how will this new rule improve lending and investments in low and moderate income communities? And let me just start with the Comptroller. Thank you.
Sure. Thank you so much for that question. So the CRA, the final rule that was just adopted, both modernizes and strengthens the CRA implementing rules. And it modernizes it by basically taking into account a lot of these banking activities that take place outside of traditional branches and ATMs. That's an important part of the rule. You know, banks do activities outside of those areas, and so now they are, under the rule, have to meet the needs of all of those that are, including LMI communities in those locations. It also strengthens the rule by putting in more objective thresholds and benchmarks for their activities, which should lead to an increase in CRA lending and investment activities across both retail and community development.
Thank you. Chairman Gruenberg, anything else to add?
Yeah, I would add, there's a lot in this rule, but third really critical point is that it gives banks the flexibility to engage in community development financing, whether lending or investment in any LMI community across the country, and get CRA credit for it. So it really helps address the issue of banking deserts, communities that lack access to banks in their local area and will now be able to seek support from banks anywhere, and those banks will get credit if the lending and investment activity takes place in an LMI community. This will benefit rural areas, native lands, and other severely underserved communities.
And thank you for bringing that. My next question was our native lands, our tribes, because I know they are so challenged, and I'm hopeful that we're also focusing on ensuring we're bringing access to essential finance there as well.
That's very much a focus of that, Senator.
Thank you, and I don't know if Vice Chair Barr, you have any additional comments?
Thank you. I do think that the rules implementing CRA have been updated in an important way. I think it'll provide additional transparency and consistency in evaluation across the agencies and across the country that will help both banks and communities. I do think this is a win-win final rule. It'll work better for banks in helping them to serve communities. It'll work better for communities themselves. I also wanted to just particularly call out the consideration that's given for investments in loans and support for community development financial institutions and minority depository institutions. I think that's a critical part of the rule, along with the clarity that's provided for a range of community development activities.
I do as well. We are challenged in Nevada with a lack of CDFIs and different opportunities to ensure we're bringing access to capital and financial means to individuals in Nevada, in our rural and urban areas. So this is really a positive change, and I just hope as the implementation and follow-through, we're seeing the intent here at the end of the day. So thank you. Comptroller Sue, can you describe how Project REACH is promoting homeownership for Latinos, African Americans, and those on tribal lands?
Sure. So in Project REACH, the OCC functions as a convener. We bring together leaders of banks, community organizations, civil rights organizations, technology companies. They have identified in the home ownership work stream very specific issues and problems and challenges with home ownership on tribal lands, because a lot of the ownership issues are quite different. So brought that together, really produced a set of materials to enable banks and community groups to engage, and hosted a webinar. I think there were several hundred people that joined that webinar, and a lot of it is about education. So there's no excuse, because before there was a sense of, oh, this is too hard. We've now made that much easier.
Thank you. Thank you, Mr. Chair.
Thank you, Senator Cortez Masto. Senator Kennedy from Louisiana is recognized.
Thank you, Mr. Chairman. Mr. Gruenberg, what the hell's going on at the FDIC?
It's a troubling question, Senator. I read the report as you did. As I indicated earlier, it is deeply disturbing and troubling, and we're going to bring all the resources of the FDIC to bear to understand what is going on, what has occurred, and how we can most effectively address it.
Have you ever, how long have you been at the FDIC?
I joined the board as a member in August of 2005.
Okay. Almost 20 years then, huh?
Yes, sir.
Have you ever sexually harassed an employee at the FDIC?
No, sir.
Apparently, you're the only one. I just find this incredible. A former female employee recalled her male colleagues saying women needed to use sex to get ahead at the FDIC as they stared at her. Did you read that?
I did, Senator.
Quote, according to one young woman, it was just an accepted part of the culture. One of the female examiners received a photo of a colleague's penis. During lunch with an examiner, another young female employee who had become friendly with this person she was having lunch with, the guy she was having lunch with complained to her about his marriage, telling her he wasn't having enough sex. And then he said to the young woman, obviously, if I walked into this office and you were naked, I'd F you right here. Did you read that?
I did, Senator.
Did you read the 2020 Inspector General's report when it said that the people at the FDIC were acting like they were in Animal House or Porky's Revenge? Did you read that report?
I read the Inspector General report, Senator.
And what'd you do about it?
Well, I was not chairman at that time. There were 15 recommendations, if I may say, 15 recommendations in that report, and I believe the agency addressed all 15 of those.
What did you do about it personally? What was your position at the FBI?
I was a member of the board at the time, but I
And
was
what
not.
did you do about it personally?
At that time, I didn't have the responsibility of the
You didn't do
chairman.
anything, did you?
Not at that time, Senator, no.
Okay. Did any of your other fellow board members do anything?
It's a general matter that falls to the chairman who's responsible for the day-to-day
Or was
management.
somebody else's problem, not yours?
No, well, I was a member of the board to the extent that we were consulted, but in this matter, it's really a management.
You didn't think you had a fiduciary obligation to those young women and to the organization and to the banks that put up the money?
Well, certainly as a board, we had that obligation, but it really falls to the chairman to take the lead on those.
Somebody else's fault.
Well, it was a
I mean, that's
chairman.
what you're saying, isn't it, Mr. Chairman?
No, I think the board,
Sounds to me like it.
well, not, Senator, if I may say it, board certainly has a oversight responsibility, but in the day-to-day management of the agency, which matters like this would fall to, I think it's reasonable to expect the chairman to take the lead.
Well, when the banks last spring screwed up out in California, you blamed it on their board, didn't you?
I think the report that was done on the failure found that the root cause of the issue was the management of the institution.
Right.
They also found accountability for the supervisors.
The board was blameless, is that right? Is that what you're saying?
No, I think the
Kind
agency,
of like the board at the FDIC, it's blameless?
if I may say, Senator, I think the report found, and I think I would indicate that we shared a responsibility as a supervisor.
You and your colleagues ought to hide your head in a bag. This is no country for creepy old men. And they got no place at the FDIC. And this wasn't a news flash for you. You had a 2020 report and you sat on the board. And you didn't do anything. And your colleagues didn't do anything. Mr. Barr, let me ask you about Basel III endgame. I know you know this, about half of our credit now in America comes from non-banks. Isn't your increase in capital requirements just going to make credit more expensive for banks and push people in the non-regulated, non-bank financial system?
Senator, the capital increases mostly affect trading activity of banks and other non-lending activities of banks. With respect to credit, we expect the proposal to have only a very modest effect on the price of credit. For example, if all of the operational credit risk...
You would stake your reputation on that?
I believe that the analysis is correct in the proposal to the rule.
Okay, if
but
I
we
could
are-
ask one more question, Mr. Chairman, if that's okay.
But we're very open to comment on the proposal. So if people have other analysis that would help us make a better judgment about that, we're very open to it.
The banks out west and elsewhere that went broke last spring, would this change have prevented that?
The banks that suffered losses primarily because of interest rate risk.
It
And
wouldn't
this
have
proposal, sorry, if
I'm
I
gonna
may,
get
sir.
to-
Senator Kennedy, last question. This is it.
If you could just answer my question.
I'm
My
trying to,
friend-
sir. Yes, it would directly address that because for large banks, their interest rate risk would be brought into the capital roll. Their unrealized losses and gains would be reflected in capital. So it does directly address the kind of risk that we saw.
Senator Menendez is recognized.
Thank you, Mr. Chairman. The United States is facing a housing crisis, and affordable housing advocates I've heard from are concerned that the new capital requirements proposed by your agencies may make the problem worse. An analysis from the Urban Institute indicates that banks affected by your proposal account for more than half of all mortgage originations. The Urban Institute's analysis further indicates that the proposal will disproportionately increase costs for Black, Hispanic, and low and moderate income borrowers. So one effect of this proposed rule seems to be in direct conflict with the goal I and many members of this committee share to close the racial home ownership gap and make housing more affordable for first-time home buyers, particularly buyers of color. Vice Chair Barr, Chairman Gruenberg, Comptroller Sue, as you work to finalize this rule, what do you say to Black and Hispanic communities who are concerned that your proposal could make the dream of home ownership even more difficult to achieve?
Senator, first let me say we take these concerns very seriously. We're quite open to comment, and we want to improve the rule before we get to a final rule. This is one area where we've heard there may be concerns that the mortgage rules are overcalibrated. Of course, the proposal leaves the same rules governing mortgages that are issued by FHA or that are insured by Fannie and Freddie, that are guaranteed by Fannie and Freddie, agricultural loan, VA loan. So those rules don't change. Those are most mortgages in the country. But we do care very much about access to credit for low and moderate income borrowers. We hear those concerns, and we will very much take those into account as we work to finalize the rule.
If I may say, Senator, we're deeply sensitive to this issue. The preamble to the rule actually asks a couple of questions and outlines alternative approaches for risk weights in regard to mortgages, and I'm hopeful that we'll be able to address this issue in the final rule in a satisfactory way.
I agree with what Vice Chair Barr and Chairman Gruenberg said.
Well, I appreciate your desire to maintain safety and soundness in the financial system, but I would encourage you to also ensure that we keep enough capital flowing so hardworking borrowers can become homeowners. And while it's true that some of those other entities, FHA and others, may not be affected by this, not everybody is necessarily going to fall in that category to qualify, so it's really important. I want to thank you all on the work on the updated CRA rule. I think the changes make a strong step towards more accurately evaluating and encouraging banks' engagement with low and moderate income and minority communities that for far too long have faced barriers to financial inclusion. However, even the strongest of rules won't have an impact unless they are accompanied by appropriate supervision and enforcement. We saw earlier this year with the collapses of SVB and Signature Bank what can happen when regulators fail to properly supervise their charges and enforce our banking laws. So Vice Chair Barr, Chairman Gruenberg, Comptroller Sue, as you work to implement the updated rule, what will you do to ensure your supervisory teams are fully trained and properly evaluating banks under the new guidelines?
Senator, you raise a very important point. Having an effective rule is only effective if you have effective implementation. We're going to be taking the next 2 years as the rule comes into place in 2 years from now to make sure that we have good, strong training for examiners, that we have good guidelines for examiners, that we make sure we're working very closely with banks and communities in partnership on implementation. So we have an implementation approach that works for banks, that works for communities, that provides the clarity that both banks and communities want. Mm-hmm. We're going to be developing online tools to help banks be able to comply with the rule at lower cost and to provide transparency to consumers and households that want to know how banks are performing under the rule.
Senator, I would underscore that the three banking agencies worked collaboratively to finalize this rule, and we do think the final rule is a strong one. And I think we're all committed to work together in a coordinated way on the effective implementation. As Vice Chair Barr said, the rule is only as meaningful as its implementation will be, and I think we're all entirely focused on that.
And I can say that staff are already working on implementation as we speak.
All right, I look forward to seeing the actual implementation and the way it's meant. Finally, Vice Chair Barr, you and I have spoken about the broken process for selecting Federal Reserve Bank presidents, which in 109 years has never resulted in a Hispanic or Latino bank president. And during the confirmation process, you made a commitment to develop a transparent process with meaningful public input on the selection of Federal Reserve leadership. I suggested 6 ideas to you. Since then, we've had a series of openings at Kansas City, Chicago. There's one ongoing in St. Louis. Can you give us an update on your efforts to reform the selection process? What changes have you made, and how have they impacted the recent and ongoing searches?
Thank you, Senator. First, let me say I share your view that diversity among Reserve Bank presidents and among the staff of the Federal Reserve and among the Federal Reserve Board and the FOMC is an important part of making sure that the Federal Reserve as an organization hears lots of perspectives and makes good decisions. There have been improvements in the process for selection of Reserve Bank presidents, improved transparency, improved outreach, but I think we have more that we need to do in that regard.
Thanks, Chairman. That is Senator Lamas of Wyoming is recognized.
Thank you, Mr. Chairman. Chairman Gruenberg, I came down on you when you were here before with regard to the fact that you and CFPB Director Chopra and Acting Comptroller Sue voted to oust your predecessor. She was a highly qualified woman. So you ousted her, and now you're the chairman. You've been there for 18 years at an agency that now has been exposed as having a hostile work environment towards women, that women are denied opportunities for advancement. They are denied opportunities to travel on the road. So this disgusting behavior can continue among your colleagues, people who work for you under your direction. We know that some of the employees who harassed women at the FDIC found employment at other agencies. Great. Send them elsewhere instead of oust them from the system. The careers of women have been stalled out, and that the culture is skanky at the FDIC. It's disgusting. So, what reforms to civil service do you need to remove bad employees from positions of public trust instead of shuffling them to the Fed or the OCC? And further, what are you specifically going to do about this?
Senator, thank you for the question. As I indicated earlier, we are undertaking a comprehensive review of the agency, both Washington as the regional offices and the field offices, to try to get a handle on the nature of this issue. We are utilizing an independent third party to assist us in that and to try to get at the underlying issues that you raise. And the issues will go to both management providing confidence to employees that they can, in a safe, secure, and confidential way, register complaints. If
Yeah,
they're-
tell me why you haven't done anything since you became chair about this. Did it take a Wall Street Journal article so you were publicly outed for this disgusting work culture? Why, when you had the earlier report in your hands, didn't you do anything about it?
Well, Senator, if I may say, that earlier report had 15 recommendations, all of which the agency resolved to the satisfaction of the IG.
Did it change the culture?
I think it probably didn't, and I think candidly that's the underlying issue here. And I raised that earlier, that it's not simply a matter of policies and procedures, but trying to get at the underlying issues that make it challenging for employees to utilize them, and that management has a responsibility to enable employees to do that. And I think that's what we want to focus on.
Okay, so you know that people were either puking off of roofs and peeing in elevators or vice versa.
Well, that was certainly in the report, and that's certainly things we will be looking at.
Okay, you know, if that happened in my office, I would be doing a lot more than looking at it.
Well,
I mean, that's so far beyond the pale of what would be acceptable human behavior anywhere, let alone in what is supposed to be a respected federal agency. That just looking at it or having a third party come in and evaluate, that is bureaucratic mumbo jumbo for we're doing nothing and nothing is going to improve. And I think this is so far beyond the pale that I'm just going to say you sure as heck better do something about this. Now, I want to switch and ask one question about Basel III. The largest banks have already said that these onerous restrictions will decrease their lending activity. So to all of you, what's more likely, that overall consumer lending will drop, such as people who want to buy a house or a small business, or that lending will migrate to non-bank entities that are more opaque?
Senator, our expectation is that given the very small nature of the credit changes in the rule, that credit would not significantly change under the rule, but we are open to public comment on this. We're happy to receive comment. Earlier, the gentleman mentioned one such comment. We're open to all comments, and we'd be happy to take them into account.
Thank you. My time has expired. Thank you.
Senator Warner from Virginia.
Well, thank you, Mr. Chairman, and it's great to see all of you. Thank you all very much for your service. You think about the fact when I first got on this committee, when Chris Todd was chairman, we got right into the middle of a financial crisis, and I would actually argue to all of my colleagues that the resulting legislation of Dodd-Frank actually stood the test of time. We went through COVID, we've gone through SVB, we've gone through digital asset issues. But I also think one of the things we at least learned from SVB is, there's no single tool that's going to solve all the banking crisis, and particularly when you've got to run in a 6-hour period that takes 25 cents on every depository dollar. Frankly, no capital requirements in the world are going to meet that. Chair Gruenberg and Vice Chair Barr, I've met with you and want to continue meeting with you. I've raised privately, I'm going to raise publicly some of my concerns now with the Basel III rule. Not only in terms of the capital required, I do want to get into more of the comments some of you made that a number of the major GSIBs are already meeting those new capital requirements, but I do feel like this could be the moment of a perfect storm where you've got the challenges around rising interest rates, you've got quantitative tightening, you have the challenge that I've been concerned about some time is that this may actually result in pushing more lending outside the regulatory perimeter. Later on top of that, we've got a lot of geopolitical risk, and I do think, and I appreciate what you've both said to me, that you are going to look very carefully at the comments. I worry a little bit about the schedule, that the comments may not come in, until after the rule gets close to finalization. And again, I really want to make sure that you are listening to legitimate concerns. Let me also acknowledge to my friends on the banking side of the House that any time I've heard since I've been on this committee, no matter what happens, any new regulation is going to lead to this dramatic decline in lending. That Chicken Little approach that every new regulation is going to be the end of lending on Main Street really lessens your cause, when this may actually be the time when, and as we've seen from some of the civil rights organizations, real concerns about that lack of lending in the mortgage field. So I do want to also bring to the table an issue that I don't think that's been really raised yet, and that is, as we think about how we strengthen our system, and before we think about adding a whole lot of new tools, one of the things I think we really ought to look at are some of the tools that frankly haven't been used. And back when the Federal Reserve was created, we created the discount window. And in many cases, usage of that by banks could have potentially alleviated this crisis. Particularly SVB, it was clear they didn't even know how to do it. And I think it's been clear that the idea that kind of instead of using the discount window, we're going to go to the Federal Home Loan Bank, that's just not a good enough alternative. So I appreciate what the Fed put out this summer in terms of encouraging more usage. One of the things I've raised with both of you, and I know I'm going on, but I'd ask Mr. Barr and Mr. Gruenberg to comment, should we go beyond this encouragement of using the discount window and actually require some level of mandating? How you do that, devil will be in the details. But unless we can make this a normal course of operation, and I don't have any sympathy for banks who then say, well, that would put us under the stigma from the market. Well, you can't complain about regulations and then not use the tools that are already existent. So how much further could we go to make sure that the discount window in terms of liquidity issues is used in a more effective way? And I'd ask both of you to comment.
Thank you very much, Senator, and I've very much enjoyed our conversations over the many years now on these sets of topics. I've learned a great deal and continue to learn. We look forward to the comments on all the aspects of the rule that you have indicated. With respect to the discount window, we really are encouraging banks to use the discount window as well as the Bank Term Funding Program that we set up during the March banking stress. Both of those kinds of programs are really essential for providing liquidity to the system. And use of the discount window and the BTFP really calmed the situation down in March and prevented the kind of massive liquidity flows. We're looking broadly at our liquidity rules to see whether we might make improvements. We are looking at the kinds of issues you raised with respect to making sure that banks are prepared to use the discount window, they have good contingency funding plans, they test those plans, and they use the discount window. So I think you raise an excellent point.
Mr. Chairman, I got 20 seconds more I'd like to go, but just go ahead quickly, Marty. If
Yes,
you could.
Senator, I agree with the points that Vice Chair Barr just made. I think the discount window is the reliable source of liquidity for short-term liquidity under stress. We want to try to address any stigma attached to it. Management of collateral and timely management of collateral to access the window is critical. And the notion that you raised about either pre-positioning collateral or requiring some periodic use to demonstrate the capability to utilize the discount window is something we might take a look at.
Thank you both. And I won't ask another question, but I do want to make one quick point. And I've spent a whole lot of time on artificial intelligence, maybe not as much as Senator Rounds. I can't think of a subject that is less linear, at least for me, in terms of time spent. Doesn't mean I'm getting smarter on it. But one of the issues, and Senator Kennedy has agreed to work with me on this, is I'm extraordinarily concerned that AI could lead to massive market manipulation now. And if there was ever an issue that seems tailor-made for FSOC, and I'd love to come back at a different time and pose that to you all. Thank you, Mr. Chairman.
Senator Daines from Montana is recognized.
Chairman, thank you. I'll talk a bit about what's going on in the current economy. Certainly a historic moment. Inflation saw a better report here this morning. It's encouraging. Still a long ways to go. Combating inflation, as we've seen the Fed has done in the last couple of years, they had no choice but to raise interest rates in an attempt to counteract what was happening. We talked at length in several committees. It was kind of a blue jersey, red jersey exercise before some of these massive spending bills were passed here in Washington. This would be a potential inflation risk, and the chickens did come home to roost. Is that my feedback there? So on top of that, we saw the bank failures earlier this year. I believe in large part due to regulators being asleep at the switch, as we probed in great depth in many of these failures. It's clear these failures were not due to insufficient capital. Nevertheless, you're moving forward with a flawed Basel III endgame proposal. This proposal will limit credit availability to small businesses. I'm hearing it in both ears from our businesses back home across Montana. We had 4 Montana small business owners in the office here this morning who flew in to express their frustration with this regulation. Look, we're from a state that is a small business state. We are not the land of massive C-corps. We're the land of small businesses. In fact, 99% of our businesses are small business. I think we have one of the highest percentages of small business in the nation. And when they take a hit, they have to pass these increased costs on to consumers or they go under. So we're looking at higher inflation or loss of jobs, which is 2 very difficult outcomes. I'm happy to have joined nearly 40 Republican senators, including every Republican member of this committee, urging this proposal to be withdrawn. Vice Chair Barr, if banks are required to keep even more money on the sidelines, as this proposal requires, that's going to have a direct impact on business across my state. We're hearing it from our banks. Additionally, and by the way, these aren't the GSIBs. We're hearing it from the smaller banks. Additionally, the public listing requirements will further exacerbate the problem, as most small businesses are not publicly traded companies. They don't have massive compliance departments. Other jurisdictions, such as the EU and the UK, have seen the negative consequences firsthand, and they've dropped the public listing requirements. Has there been any cost-benefit analysis for this? And why are you continuing to push something that has already been proven to be so detrimental? Vice Chair Barr.
Thank you, Senator. First of all, let me just say we take these concerns seriously. We want a capital rule that works for small businesses. We want a capital rule that works all over the country for different kinds of communities. We don't anticipate that this current rule will have adverse effects on small businesses based on the analysis. Very small part of the rule actually affects credit. Most of it is about trading and derivative activities. But we do pay attention to these issues. We appreciate the comments. If we can improve the rule, such as you suggested with respect to the listing requirement, we will do that. Under the rule, for the first time, small businesses...
Thanks for that. So you will do that, or you'll look at doing that?
We'll have to review the comments.
Okay, I heard you say you will do that. Okay, all right.
We're in a public comment period.
Okay.
If it turns out that the comments show that we should make changes to the rule based on small business input, we will do that. Okay. So I need to, of course, be completely open and am completely open to hearing those comments. I won't prejudge the outcome of those comments.
I wonder how many small businesses are cheering this on right now. I'd be curious if you kind of looked at the, poll the audience here. I can't imagine too many small businesses say this is a great idea.
As I've said, Senator, in response to other questions, this rule only affects the largest 37 banks in the country. It doesn't affect any banks in Montana. It doesn't affect any community banks. The small business provisions in the rule actually provide more flexibility for a lower risk weight than is currently under the law. Right now, our current rules have a 100% risk weight for small businesses. Under this proposal, which is more risk sensitive, small businesses can actually have a lower risk weight. That means banks hold less capital against them than they do now.
It's getting harder and harder. So I'll just say for our banks back home, having spent most of my career not in a suit and tie here, but as part of small businesses, it's getting harder and harder to get capital at the moment. It just is. And this is a real concern about when they look for alternatives to find capital. They can't get it with local banks. This becomes a real issue for business to keep growing here, and I've heard it again very clearly, articulated well from my small businesses. Last question, I know I'm out of time. You yourself have said many times the U.S. financial system is strong and well capitalized. In fact, that's the consensus from everyone on this panel today. Chair Powell has rightly stressed that the Fed is and should be a consensus organization. However, it appears that despite wide disagreement on the scope of the proposal, you're determined to see through, regardless of the impact this will have on the financial system, which I might add hasn't even been sufficiently studied, given the lack of consensus. You might hope you would try to get consensus, but this is turning into a very, very partisan kind of outcome, and it's dividing versus uniting. Are you going to be substantially altering or resubmitting the Basel III proposal to better reflect the concerns of other members of the board in the spirit of trying to get consensus?
Thank you, Senator Daines. As I've said previously, I am a big believer in trying to reach broad consensus on the board. I don't know that we can get unanimity on every rule, but broad consensus. Of the 50 rules or supervisory actions that have come up since I've been at the board, of those 50, almost all of them have been unanimous decisions. So I do very much value that, but it's an issue that I'll continue to work on.
Chairman, thank you.
Senator Warren from Massachusetts is recognized.
Thank you, Mr. Chairman. I shouldn't have to say this in 2023. Sexual harassment is never all right, never. It is important that the FDIC leadership gets to the bottom of this and holds harassers accountable. Now, last spring, the second and third and fourth biggest bank failures in the United States history occurred. Those failures cost the FDIC over $30 billion. In other words, the investors and executives took on big risks, they made big money, and then they left the U.S. government on the hook when they couldn't cover the outstanding deposits. That's not supposed to happen. After the crash of 2008, regulators were supposed to put in place rules to require big banks to have enough capital to cover financial shocks so that taxpayers won't have to do that. And now here we are, 15 years later, and regulators are finally near the finish line. In July, they put out proposed rules for stronger capital requirements, including the so-called Basel III endgame rules. But Wall Street executives don't want to have to put up more capital. Higher capital standards make banks safer, but they also nip into profits and make it harder for CEOs to pull in multi-million-dollar bonuses. So the CEOs and their big-time investors have hired an army of lobbyists to stop the new capital standards from ever seeing the light of day. Their leading argument right now is that stronger capital requirements would hurt lending to small businesses all across America. I think we've heard some of that this morning. Vice Chair Barr, how many insured depository institutions would the rule apply to?
37.
37. So there are almost 4,700 insured depository institutions in the United States. If I have my math right, that means the capital rules for more than 99% of the nation's banks, including the community banks that serve small businesses, farms, and American families, those rules are not going to change one bit. So Vice Chair Barr, for the 1% of banks that are covered by these rules, will stronger capital requirements make it harder for them to extend credit to small businesses?
We don't believe so under the current proposal. The effects on the credit side of the house are very, very small as a portion of this rule, but we're, of course, open to comment on that issue.
So am I understanding that you're saying that most of the capital standards are related to non-credit activity, that is, not to small business lending?
That's correct. Most of the increases result from trading and derivative activities and operational risk associated from non-lending activity.
Okay. So the lobbyists for the big bank CEOs claim that stronger capital standards will really hurt lending, which just isn't true. But where are the lobbyists for the American people? Remember, if we don't get tougher capital requirements, the next time there's a problem, it's taxpayers who will be forced to pick up the slack. As I read the new capital standards, they apply, for example, to trading in risky financial products like derivatives. They also apply to things like operational risks for fraud or processing errors. Vice Chair Barr, have big banks ever lost money on risky financial products and activities?
Yes, Senator, they have. For example, in the worst quarter of the financial crisis, banks lost about $38 billion from those kinds of trading losses.
Okay, and what about operational risks? Have big banks ever lost money because of those?
Yes, unfortunately, banks have lost significant sums from operational risk, rogue trading activity, activity related to illegal sales practices, mis-selling practices in retail brokerage and otherwise.
And that is where you have focused the increased capital standards, am I right?
That is correct.
So the Fed is focused with surgical precision on raising capital standards for the 1% of banks that pose the biggest risk to the economy and on the specific banking activities that pose substantial risks. I understand that the lobbyists for that 1% of banks don't like it, but we don't work for them. The proposed rule is now 15 years overdue. I urge you to finalize it and put strong capital requirements in place as soon as possible. Thank you.
Thanks, Senator Warren. Senator Warnock of Georgia is recognized.
Thank you very much, Mr. Chair. I share the concerns raised by my colleagues of these awful reports we're hearing, and I look forward to working with the chair to address the culture of sexual harassment and unconscionable behavior.
Thank you, Senator.
People across the country are facing higher borrowing costs to purchase homes, to start businesses, as a result of rising interest rates. Many large banks have made minimal adjustments to the interest that they pay customers on deposits and families' checking and savings accounts. This means that while borrowing has clearly become more expensive for families, banks continue to borrow cheaply from their depositors to lend out at these higher rates that all of us are seeing in the marketplace. So families aren't getting more for their money. Mr. Barr, why have banks kept the interest rates they pay to customers so low?
Thank you, Senator. Banks are paying up a bit in relation to the rising interest rates that we see. The rates that we're seeing follow a kind of normal pattern, which is that banks don't fully pass through interest rate increases to consumers, but we are seeing essentially a somewhat of a paying up in that environment.
Are you satisfied with the increases that they're passing on to their customers?
We don't get involved in any way, either positively or negatively, with respect to pricing decisions of banks.
So, let me ask you a different question. Are these spreads abnormally large compared to high interest periods that we've seen in the past?
They're about in line with prior historical experience.
Are you taking measures to encourage banks to offer better yields?
As I said, we do not get involved in any way in pricing decisions that banks make.
Right, let me just say that I think it's unfair that families are facing higher borrowing costs while banks enjoy the advantage of borrowing at low rates from the public. And we need a system where both consumers and banks share costs and the benefits proportionately. I'm going to move on to another topic. I mean, these same banks are finding other ways to increase their pay at the cost of customers. As of last week, customers at several of the largest banks in the country were still unable to access their paychecks after a payment processing error on November 2nd disrupted the direct deposit process. Mr. Barr, who is responsible for this error that has left too many Americans without access to their deposits and in many cases without the ability to pay their rent or their bills?
My understanding, Senator, is that a private payments clearinghouse was responsible for the error. We have urged banks that have affected customers to work with those customers given that error.
Thank you so much. As chair of the Financial Institutions and Consumer Protections Subcommittee, last year I held a hearing to examine the consequences of bank overdraft fees on working families. And I'm proud to say that after our hearing, 4 of the 20 largest commercial banks in the United States reduced or eliminated their overdraft fees. This summer, I convened a separate hearing to examine the tactics used by unscrupulous financial institutions to extract more money from consumers using surprise and unnecessary junk fees. Today, I'm concerned that customers affected by the recent ACH payment processing error may be stuck in a difficult financial crunch through no fault of their own. I'm concerned that banks may unfairly penalize them by charging overdraft fees or non-sufficient fund fees when they try to pay for basic living expenses using money from their hard-earned paychecks that they reasonably expected to receive, but may not be there due to processing error clearly out of their control. Mr. Sue, Mr. Gruenberg, Mr. Barr, if we could just go down the line with a quick yes or no. The Baptist preacher's the one senator who's going to stay within his time. Yes or no, are you encouraging banks to waive their overdraft and non-sufficient fund fees for customers affected by this processing error?
We've encouraged banks to work with with their customers to make sure that their issues are addressed, and our understanding is that they're working with them.
Great.
Senator, the answer is yes, and I believe the banks are doing that.
The same response.
Thank you so much.
Thank you so much, Mr. Chair. And let me just start by appreciating our conversation yesterday, Chairman Gruenberg. It was almost immediate that you and I were on the phone talking about the toxic culture, sexual harassment challenges that have long been, according to the report, long been alleged as a part of the FDIC environment. I look forward to our follow-up conversations, particularly as a number of the complaints were emanating out of the California offices. And the regional investigation and review that emerges, I do look forward to us staying in conversation. Mr. Chairman, I'm going to try to keep my questions brief and relative to one topic. On November 5th, there was a New York Times article that outlined and made reference to challenges that customers were facing getting with their accounts being closed because of algorithmic and or other technology challenges that prevented, on another instance, prevented depositors from being able to access their funds, pay their bills. Here's a first start question. Can each of you talk about any steps your agency has taken to examine its risk management practices that would ensure that banks and credit unions are not unintentionally or intentionally closing the accounts of customers who are engaged truly in lawful activities?
Thank you very much.
They're all looking at you, Scott.
It's okay. Thank you very much for the question, Senator Butler. I'm not exactly sure which article you're referring to. There's a couple different issues that have been risen recently. I will say if it's related to the issue that Senator Warnock rose with regards to the payments TCH, so that we understand the root cause analysis of that is ongoing, but we understand that that was the responsibility of a particular private entity that serves as a clearinghouse for payments. It does highlight the importance of operational risk management and operational resiliency. And that is something that we expect all banks to have appropriate risk management around those issues. That's very, very important, especially as technology, banks increasingly rely on technology for those processes.
And let me just follow up, Mr. Sue, because I appreciate you raising that, the operational risk management and the highlight there. Is it your intention then to issue new guidance or revise current guidance that would help the institutions to actually alleviate these kinds of practices or better manage this kind of risk?
Sure. So there is existing guidance right now in terms of operational resilience and risk management. We promote those and we support those. We're constantly thinking about, do we need to take steps to strengthen that? And that's a conversation that we have internally and as well across the agencies.
Senator, if I may say, I think you raise a very important issue. Algorithmic lending activity can have let us say, unintended consequences, both in terms of cutting off people from their access, as well as having fair lending issues associated with it as well. And it is the subject of supervisory attention in the course of our examination process. And I think it's a growing issue and one we need to pay attention to.
Thank you for picking up on the point, Chair Gruenberg. There was mentioned by my colleagues earlier the growth and breadth of the influence of artificial intelligence, and there have been many hearings and conversations in this building and in others about the potentially unintentional bias built into the artificial intelligence tools, and to take into consideration how that bias shows up in our financial systems, I think is an important place for us to do some real work to maintain the trust of our consumers as we move our economy forward. Thank you, Mr. Chair.
Senator Smith of Minnesota is recognized.
Thank you, Mr. Chair. Thanks to all of you for being here. I want to talk a little bit about the impact of technology on what happens when there's a crisis. And Chair Gruenberg, you and I talked about this a little bit when we spoke a day or so ago. So the smartphone era appears to have given new meaning to the term bank run. Social media and mobile banking certainly wasn't the cause of the failures of Silicon Valley Bank and Signature Bank. And as both the Fed and the FDIC noted in your reports, both banks had far deeper issues. Yet technology did help to facilitate the unprecedented speed, both of the runs on both banks and kind of the impact of it. And it seems to me that this is something that we should be looking at as regulators and banks reckon with this. So Vice Chair Barr and Chair Gruenberg, could you tell me how you're rethinking or thinking about your regulatory approach in light of your findings and what we need to do looking forward to manage the impact of this technology risk?
Thank you, Senator Smith. I think you raised an important point. I agree with you that the underlying issues at these institutions were deeper, but of course, in the moment of crisis, there was a very, very quick set of bank runs. And so we are looking across the range of tools we have, our supervisory tools. We want to make sure that banks are prepared with good, sound contingency funding plans. We want to make sure that those plans, where appropriate, include access to the discount window. Mm-hmm. If the contingency funding plan includes access to the discount window, that they are testing that they make sure that they understand how to use the discount window. And many institutions have responded to this by pre-positioning collateral at the discount window, which is a very strong and good and prudent risk management practice we are encouraging institutions to do. We are going to look more broadly at our liquidity rules, our approach to liquidity management, and expect we'll have more to say about that in the coming months.
Thank you very much. Chair Gruenberg.
Senator, we learned a lot about liquidity risk earlier this year. We learned about concentrations of uninsured deposits and how quickly they can run. We learned how large depositors can withdraw those deposits at the push of a button. And we've also seen how social media can amplify concerns about institutions very quickly. And the last one was probably a secondary but contributing factor. I do think it is, in a sense, a new kind of liquidity risk that both the banks and the regulators need to pay attention to. A bank really needs to monitor what's being said about it on social media. It may be accurate or it may not. And similarly, as regulators, we need to monitor what's being said about the institutions we supervise on social media, and we actually are looking at utilizing different means of technology to try to do that. But I do think that's an additional liquidity risk challenge that we're presented with.
So it's interesting, you both see this as a different kind of liquidity risk and something that we need to monitor and plan for. And it also seems to me that with the proliferation of misinformation and disinformation, that the financial institutions are also potentially vulnerable to a malign effort to disrupt their operations with something that just isn't true. Mr. Harper, did you want to join in?
I was just going to add to what Chairman Gruenberg said. This underscores the importance for the NCUA of having an enhanced central liquidity facility because institutions below $250 million generally do not belong to the liquidity facility. Statutory enhancements would help that. Also, too, we do have issues with our ability to assess third-party vendors and technology. Unlike the other regulators, we do not have that authority. Certainly getting that authority from Congress would help us to have better oversight of this area and better protect the Share Insurance Fund.
Great, thank you very much. I want to just bring up one thing quickly before I close out. I know you have all been here for quite a while. I was really happy to see the Fed and the FDIC and OCC issue their final Community Reinvestment Act rulemaking last month. You all know that this is something I'm quite interested in, and I gather that it has come up a little bit today. My view of it is this is a very important update to CRA regulations, and it addresses decades of changes and of evolution in the banking sector, and I think helps to bring the core purposes of the CRA back into focus. I just maybe quickly, my question is whether you, given that it has taken so long to get this update done, have you given thought to establishing some sort of a process to review and update these regulations more regularly so that this doesn't become a thing again?
Let me just say, right now, we're really focused on the implementation of these rules. We want to make sure to get that right. I think the final rule is really a win for banks and a win for communities. We want to keep that partnership going through the implementation stage, make sure that banks and communities have the online tools they need to be effective and efficient in deploying the rule, make sure that examiners have the training and guidance they need. So really our focus is on that. And we've set up a process to make sure that as questions come in on the rule, is this activity covered, is it not covered, that we provide clarity on that.
Sort of a real-time way of getting feedback so that banks can understand what it means to get the rules right. Yeah. I know, Mr. Chair, my good colleague from Maryland is eager to ask his question, so thank you very much.
Thanks, Senator Smith. Senator Van Hollen of Maryland is recognized.
Thank you, Mr. Chairman. Great to see all of you. I'm actually going to start where Senator Smith left off, really in commending all of you for working together, all those involved, with updating the CRA rule. Because as we all know, the banking system has evolved dramatically since it was first passed, and it's very important that we have rules that adapt to the changes so that we meet the original intent of the CRA. I also do want to commend you for just earlier this month removing the Trump area barriers to designating non-bank system entities as SIFIs, as systemically risky, if it bears that out. It's something I've been urging for a long time, and I was very glad to see all of those agencies represented here who have a vote to clear the way so that we can move in that direction, and look forward to talking with all of you further about that. I do want to say something about real-time payments and FedNow, something I've been pushing for years. A number of us introduced legislation to try to accelerate that effort. According to Aaron Klein of Brookings, had the United States implemented real-time payments when the Bank of England did in 2007, lower income consumers, people living paycheck to paycheck, would have saved over $100 billion on overdraft fees, check cashing, and payday lending. That's a $100 billion tax on people who can least afford it. So I'm glad this is finally kicking into gear. Mr. Barr, if you could just speak to what you are doing to make sure that banks fully participate so that we can maximize this benefit.
Thank you, Senator, and thanks for your longtime support of this initiative. As you noted, FedNow launched this summer. We expect it will take some time to build a full bank participation. We've built the underlying rails. We really need banks now to come in and participate. We think it'll be a very attractive option for many banks to join in to be able to offer this service to their customers and businesses. We have a very active outreach program working with banks to encourage them to participate. We have a very active outreach program to third-party service providers that work with particularly community banks. But I think this is something we're going to have to keep at month after month after month. It's going to take a long time to get right, and we promise we're going to stick to it.
Well, I appreciate that. Any help you need pushing from here, from the Senate, let us know, because, again, we were late to this game. We were late getting started. Now we have to maximize our efforts to get participation. If I could just raise some of my concerns with certain aspect of the Basel III regulations as they relate to potentially being a drag on the deployment of clean energy. Last month, the three banking oversight agencies represented here issued joint principles with respect to climate risks and the transition from a fossil fuel economy to a clean energy economy. And of course, one of the devices we use to try to accelerate and manage that transition has been clean energy tax credits. So I have been concerned with the treatment of those tax credits in the most recent Basel III discussions. Mr. Hsu, we talked about this prior to the hearing. Do you share those concerns, and if so, what efforts are underway to address it? And then I'd just like a brief response from the others.
So we've also heard those concerns and that feedback, and we are going to be very open-minded to the comments. We're in the comment period now, and so we look forward to getting those comments and the analysis, and we'll take that into consideration as we move forward.
Senator, I think this is a pretty good example of why you have a public comment period. I think we've received comments that raise attention to this issue that we may not have fully appreciated. And I'm hopeful we obviously are going to review all the comments, but we can be responsive and address this on the final rulemaking.
Thank you, Senator. I also look forward to the comments on this. The kinds of comments that are most helpful on this and in other areas are comments that let us understand better the underlying risk. Some people have said, for example, that these tax credits are lower risk because investors are being repaid from a stream of the tax credits. That's the kind of information that's useful to us as we analyze whether changes would be appropriate in this circumstance.
Well, thank you. I'm going to interpret those responses in a positive way, and let me leave it this way. If you're not going to address some of these concerns, I would appreciate the opportunity to weigh in before any final decisions are made. And I thank you all.
Thank you. Senator Fetterman of Pennsylvania is recognized.
Thank you, Mr. Chairman. Thank you. And thank you for allowing me the opportunity to talk to people much, much smarter than I am. And today's meeting it's protecting Main Street over Wall Street. So I want to talk about Silicon Valley Bank, because it doesn't seem like they were protecting Main or Wall Street, quite honestly. And I'm astonishing because it doesn't seem like there are a lot of people talking about this. And this almost effectively was going to blow up the economy, you know? And it's astonishing. And as far as I know, I haven't read about any kind of charges or anything like that. And, you know, that dude was back to Hawaii to his gigantic house. And again, it's astonishing that there seems to be more outrage on that as well, too. And to me, it's also astonishing that you can have one bank could crash the entire economy. And once they realized what was available, is that the White House and everybody all agreed that we have to act very decisively and quickly as well. Blows my mind that is even made possible. And my question to anyone on here, and I don't mean that to be aggressive, it's an honest question because I really don't know. So what was behind Silicon Valley Bank's crash? Was it greedy? Was it incompetent? Or they don't care because the government's going to be there to clean up this kind of a mess? Or is it one, some, or all of them, or whatever? Honestly, because I don't understand what it actually is. So I want people, experts and much smarter than me, to know where it was.
Senator, first of all, let me say I appreciate and agree with your outrage about what happened with respect to Silicon Valley Bank. There was significant bank mismanagement of interest rate risk and
That's a
liquidity
wonderful
risk.
euphemism, mismanagement, but yeah, I'm sorry.
And, they engaged in activities such as eliminating hedges that would have helped them deal with interest rate risk in order to increase short-term profits. Their incentive compensation was not appropriate. It was not aligned with making sure that they took care of risk. There were enormous failures at that institution. I share your outrage about the conduct.
Senator, I think the short answer to your question is all of the above. I mean, this bank touched all the bases.
All of the above? Right, okay, yeah.
And it was positioned so that when it experienced stress, because of its reliance on uninsured deposits, that had a contagion effect on other institutions that really did, for a moment, put the system at risk. And that was the larger issue that was revealed here, I think.
I'll just say that I generally agree with both of my colleagues here on the panel. Certainly, the events of March were a reminder of us all to need to be risk-focused and ready to act expeditiously.
The only thing I would add is that there was very aggressive growth at that institution without the commensurate controls. And that's why we, as safety and soundness prudential supervisors, that we pay very special attention to that and put a lot of emphasis on that.
I want to clarify. Was aggressive growth? Is that greed? A nice way of saying greed? Because it seems to me, and I mean that's but I guess my last question, because I have less than a minute left, but it's like, should one relatively kind of a smaller bank be in the position to crash the economy? It's astonishing that, one, that's even possible, but now when it's actually happened, why isn't this like every day until we make sure this can never happen again? And I mean, I guess you effectively agree. I'm assuming that, but of course asking.
Senator, I agree with you. I think it's a wake-up call that we need strong capital in the system. We need strong liquidity in the system. We need strong supervision. I think the kind of contagion we saw suggests that there's a higher probability of default and loss given default in our banking system because of that contagion. And we need to have strong capital and we need to have strong liquidity.
And Senator, it also underscores the interconnectedness of the banking system. So we had a bank, $200 billion is not little, but it's not near the top either, but it was in a position to cause real financial stability risk.
Another 30 seconds, Mr.
Of course.
Thank you, sir. Yeah, for the other, I'm very honestly interested in.
Certainly, Marty is right on the interconnectedness issue within the system. It also highlights the need for us on the Financial Stability Oversight Council to coordinate and ensure that we are effectively working to protect against the risks so that one institution does not bring down the system.
I think the incident underscores the importance of us keeping our eye on the ball with regard to safety and soundness. That's what drives our missions. That's where we need to drive towards.
And thank you, Mr. Chairman.
Thank you, Senator Fetterman. I think Senator Fetterman's last question and the summary from each of you really summarizes the hearings well. So, John, thank you for that. Thanks to the witnesses, we will continue to work to strengthen our financial system. Senators who wish to submit questions for the hearing record, those questions are due 1 week from today, Tuesday, November 21st. To the agencies, please submit your responses to questions for the record 45 days from the day you receive them. Thanks again for your testimony and for your public service. The committee's adjourned.